Hi, my name is Eric Del Valle, and this is my mortgage research project. So again, this is my mortgage research project, and I just found this probably a better way to present everything. Powtoon gets me insane sometimes. So, our home candidate number one is a single-family home. This is probably the most common home in many suburbs, and some of the benefits are you have lots of space, you can host a lot of people. It is also very private because it is its own home. It's also very private, with basically all the privacy you could need, basically. Some of the disadvantages of this are they can get very expensive because they can become very big, these houses. And you also need to spend more money on land maintenance and house repairs. Also, a lot more house to take care of because there's a lot more room normally. Home candidate number two is a townhome. This is basically the same as a single family house, but just smushed together with all of the neighbors. So some of the benefits of this is you do not have to pay for many structural issues and not as much land to take care of. So you don't have to spend as much money on that. Some disadvantages are you are sharing walls with other people, so you can't be really loud without many complaints. Also, not as much room. Do that to make it better. There we go. Our home candidate number three and our last home candidate is the condominium. Some of the benefits, you don't have to worry at all about any structural payments or problems because most of the time that will be taken care of. Also, there's no lawn that you have to maintain because you're just in a little room. Some disadvantages, usually small, with not a lot of space for many people, and there are people all around you on all sides, so good luck with throwing a party or listening to loud music. So here are some components of mortgage payments. We have one, principal, which is amount used to pay off the outstanding loan amount. We have interest, cost of borrowing the money. Taxes, which is property assessments collected by the local government. And insurance, offers financial protection to lower risk. And there are two types of mortgages. We have fixed and variable. So some advantages to fixed mortgages is a safer loan because the interest rate does not change over the entire time of the payment. Some disadvantages are interest rates end up being a little bit higher for profit, which makes the borrower pay more money. And we have the variable mortgages. Some advantages are if done correctly, the interest rates could go down, which means you do not have to pay as much money in the long term. Some disadvantages are if not paid correctly, which that is a typo, which I'll correct, the interest could go up and you would end up paying more money. Also, more unpredictable because it does tend to shift up or down every few months or so. Here's some top 3 mortgage mistakes that homebuyers tend to make. 1, they assume all mortgage rates and terms are the same. You should always read and do some research on the mortgage rates and the terms and always talk to people about that. Number 2, putting a small amount of money down on the down payment. Doing this will most likely end up meaning you have to pay more money in the long term because you will have to pay more money, obviously. And there will be interest added on to those extra months. And number 3, but should be probably first, is being lazy and letting the debt add up by missing payments. This is something that I feel like many people have done, and they just kind of like 1 month they're not disciplined and they end up not paying it. And then they get into a nice big hole of debt. 2 mortgage qualifying ratios. Qualifying ratios are ratios that are used by lenders in the underwriting approval process for loans. We have debt to income ratios, and we have house expense ratios. Private mortgage. PMI, private mortgage insurance, actually. PMI, or private mortgage insurance, is a type of mortgage insurance you might have you might have to have if you are paying off a conventional loan. A PMI protects the lender just in case the borrower can't pay the lender. Purchasing a policy. Getting a title insurance is one of the standard steps home buyers take to close a home purchase. This will protect both the buyer and the lender from the possibility that the lender does not have free and clear ownership of the house and property, and therefore cannot rightfully transfer full ownership to you. And here's some benefits for the buyer, which is basically 2. There are obviously more, but these are the main ones. Probably the main benefit that the buyer gets is little to no down payment loans, and they could also get grants or federal credit tax. Once again, this has been my mortgage research project, and thank you so much for watching.